In this video, we're going to discuss the gross profit method and how we use the gross profit method in order to estimate ending inventory without necessarily doing a physical count. And what I mean by a physical count is a physical count of your inventory. So usually at the end of a period, companies may do a physical count to determine what they have left, and in order to compute cost of goods sold, they subtract that ending inventory from goods available for sale. Now, sometimes we don't have that option. Sometimes we may not be able to count the inventory at the end of the period, and that's where a method like the gross profit method comes in handy. So if you can imagine, think about a company that has inventory, has sales information. This is all under a computer system, and somewhere along the way there is something happens to the inventory, some accident. It could be a fire, it could be whatever it is, and because of that incident or that accident, we don't have access to the inventory itself. It either burned out or it got flooded, whatever the case may be. And if we don't have access to it, we still need to come up with estimates of what we had there. Okay, whether it be for filing an insurance claim or just for purposes of estimating for your financial reports. So the gross profit method is a fairly straightforward method that we can use. Now, it's not necessarily GAAP compliant, which means we can't use it on our financial statements, but for internal reports we can use it, and also for quick estimates of what we have in inventory we can use it. And what I just described about having potentially an issue like a fire or something like that, you can use this method as well for claiming an insurance, filing an insurance claim. And what you're trying to prove or show is that you have a systematic approach of estimating what the loss was. So this is potentially an approach that you can use. So let's look at it right here. It all stems from this basic formula that you've learned earlier on. Whatever inventory you have at the beginning inventory plus your net purchases gives you goods available for sale. And when I say net purchases here, I mean the purchases minus discounts, minus returns, and things similar to that. And then from that goods available for sale number, we subtract the cost of goods sold, is what we normally do, and then we get an ending inventory. Now, if we do not have information, precise information on the ending inventory, then it's hard to estimate what the cost of goods sold is. So what we do here is instead we estimate what cost of goods sold is based on sales data. And what I mean by that is, to come up with this estimated cost of goods sold, I'm going to grab whatever sales figure I have for the period and I'm going to multiply it times some ratio. And I know this sounds kind of open-ended, but here's what I mean by that ratio. It's more specifically the cost to retail ratio. And I'm just going to call it a ratio for purposes of discussion here, but it's you want to use the cost to retail ratio to be able to figure out what the estimated cost of those items are. And the formula for the cost to retail ratio is 1 minus the gross profit percentage on sales. Now, don't let this be complicated. What this is trying to get at is the markup. So when you come up with this, this right here, this on its own right here, this is the markup on your goods. So what we're saying is, if you mark up your goods 20%, then the cost of those goods is 80%, the complement, right? And that helps us come up with an estimated cost of those items that you sold. And you may ask, why do we do this? Well, we may have information of sales on the computer system, but we may not have information on our ending inventory because of a particular fire or something like that I described. So because of that, we're using this approach will be used in an environment where we have the sales data, but we don't have the ending inventory data. So let me give you an example. Assume that a company during a period has sales of $120,000. And the gross profit percentage on sales is 25%. So in other words, we mark up our goods 25% based on sales. So if we put this information over here, what we have is we have 1 minus 25% gives us 75%. In other words, the sales amount of 120, 75% of that is the cost, and 25% of it is the markup or the gross profit. So that helps us, right? Because then we can use this information to compute an estimated amount of cost of goods sold. So I'm going to go in here and I'm going to write $120,000 times 75% equals $90,000. So this $90,000 is my estimated cost of goods sold. Now keep in mind, this is not necessarily the exact cost, but it's just at least an estimate based on the average markup on the products that we're trying to figure out were left in the inventory. So to continue here, what we would have is, let's go ahead and do this one right here, this whole thing. So we're given information that beginning inventory is 38,000. So I'm going to put that there. And that we would have in our accounting records. We also would have in our accounting records that net purchases were $93,000, which then gives us goods available for sale. Oops, sorry about that. Goods available for sale, 131,000. And then now we have estimated what cost of goods sold is, which is 90,000. So what we have left is 131 minus 90 as our estimated ending inventory. So even though we don't have access to count that inventory, by indirectly looking at the gross profit of sales, we can indirectly come up with an estimated cost of goods sold and hence an estimated ending inventory. Okay, and if you notice now, if we're using the gross profit percentage on sales, that's technically why this is called the gross profit method of estimating ending inventory. And just as a final note here, keep in mind that I'm giving you the gross profit percentage based on sales. And you may not have that given as a figure based on sales. A lot of times we do the gross profit percentage based on the cost of the item. Okay, so if for some reason you have the gross profit percentage stated as a percentage of cost, then you need to transform it through algebra. Percentage on sales. Okay, so that you would have to do a little bit of algebra to be able to convert that to a gross profit percentage on sales. So let me go ahead and and do the formula there so you have it handy. So if you wanted to have gross profit percentage on sales, you would take the gross profit percentage on cost and divide it by 1 plus the gross profit percentage on cost. So if you do this small transformation, and we can do the algebra if you wanted to, but it's just simply the formula here, where if you want to be able to express this in a way where you can compute it easily for the gross profit method, and you are given the gross profit percentage on cost, then you need to transform it. And what I mean by that is, you could have an item that costs you $10. I guess I should be clear about this. And then you sell it for 12. Okay, so the markup or the gross profit is $2. Now the gross profit percentage, well, it depends. It's going to be equal to the gross profit divided by either the cost or the sales. So if you divide it by the sale amount, that's 16%. This will be gross profit on sales. Whereas instead, if you define it as gross profit percentage on cost, then it's still the same $2 markup. But instead, you're basing it on the $10. And that's what a lot of people usually discuss gross profit or markups based on cost. And that's why I got to give you this little note that if you do have that, then transform it. So in other words, assume you don't have this information right here. All right, the one I just highlighted. If you did not have this information here, then you would plug in the 20% on the numerator here and divide that by 1 plus 20%. So it will be 0.2 divided by 1.2. And that should give you the 16% that we got here. Okay, so make sure you are clear that whenever you apply this method, you have to have the gross profit percentage on sales.